Hi, and welcome to the Intentional Wealth Update from Morton Brown Family Wealth. I'm Dennis Morton here with Katie Brown and Cody Demmel. How are you guys?
Very well, Dennis. Thank you.
All right, so we're into the fourth quarter of 2021. Taxes are top of mind for a lot of people. We're going to potentially have changes in tax policy for later on this year. But we have a phrase that we like to use around here from time to time about not letting the tax tail wag the investment dog. When we talk about that, a lot of times people make decisions saying, I want to avoid taxes or mitigate taxes, and you'll see a flurry of activity, and you may see a lot of that at the end of this year. But sometimes letting the tax tail drive decisions isn't always the best thing for your returns. Katie, we've had an article from Schwab about building in tax efficiency. What are some of the things that we talk about when we think of how to be more tax efficient in the way that we plan and invest?
Yeah. Well, one of the things right at the front of the article that I think Schwab did a good job reminding everybody of is it's not about your returns, it's about your returns after tax. And it's like earning any other type of income. There's a certain amount of tax to be paid on that. But the goal is to be cognizant of where those taxes are coming from and when it's okay to say, now is the time that I'm going to pay it. So a lot of it is kind of around that timing of, recognizing that tax and knowing when it's time to pay it and where it should come from.
Right, because there's a disconnect, right? You check your year-end statement and it says your account was up 10% on the year, but then the tax bill comes a couple months later and you realize that 10% was actually cut by frequent trading or high capital gains, something like that. Cody, there are some instruments when you're investing that are more tax efficient than others, and that kind of speaks to the difference between an ETF and a regular mutual fund. What is the difference when it comes to tax efficiency there?
So ETFs, when you buy and sell it, you're selling it like a common stock. So you have a lot more control over when you're going to see the capital gain, where a mutual fund, when you sell it, you're selling it back to the company. So they potentially have to sell stocks inside of the mutual fund that you're holding. So you could potentially receive a capital gain, even though you still hold that mutual fund at the end of the year.
So everyone else's behavior can affect you, whereas with an ETF, it's really you're more self-determinant. So,
yeah.
Katie, when we talk about just proactive things that you can do, one of the little understood tactics is tax loss harvesting. And this is something that came up last year when we had a lot of volatility in the market. Tell us what tax loss harvesting is and how it's actually a way to improve your after-tax returns.
Sure. So tax loss harvesting is essentially where you're taking a taxable loss, which may equate to a tax deduction when you go to file your taxes. So for instance, if you buy a stock at $1,000 or $10,000, and the price, the value of that stock drops down to $8,000. If you sell it at $8,000, you've taken an effective $2,000 capital loss. Now, the great thing about the loss is that you can use that to offset other gains, or if not, when you file your taxes, you can take up to a $3,000 loss on your taxes. And if you have more than $3,000, that'll carry over from year to year until you eventually use it up, but you can capture that loss. And then the great thing too is it gives you the ability then to rebalance, reset, do other things that you need to do inside the portfolio as well.
Yeah, I was kind of fascinated earlier this year. We've got a couple of calls from clients saying, hey, I was talking to my accountant and they said I had a loss in 2020. I thought my account was positive for the year. And we had to point out, say, yes, you did make money, but we were able to book a capital loss to help offset gains. It helped in rebalancing, especially as markets get back up to highs and you say, listen, we want to take a little bit of profit. You can take that profit, use some of the losses to offset. Katie, you're also highlighting a situation on capital gains harvesting too. That's another interesting piece.
Yeah, I think a lot of people don't realize, they just assume that if they're, as we said before, if you're making money, then oftentimes you have to pay tax on that money. Well, there are some situations, if you're a married couple and your adjusted gross income is less than, I'm trying to remember the exact number, $80,000, very close to $80,000, your adjusted gross income is less than $80,000, your capital gains rate, so that's if you hold something for more than a year and now you have a gain on it, that capital gains rate is 0. And I'm thinking, this fits really well in with some clients not receiving distributions from the retirement accounts yet. Maybe they're not receiving Social Security, for instance, so their taxable income may be really low. And the benefit in harvesting those gains, once again, then you can reset your cost basis so that in later years, maybe when your income is higher and you do have a capital gains tax rate that you're subject to, now if you take those gains ahead of time and you reset that basis, then your gains later may be less. And so I think that's a strategy that's often overlooked or just not as considered.
Right. And so much of it comes down to awareness of where you are uniquely in that situation. As you're migrating through career and into retirement, suddenly you have things popping up that are being taxed very differently. And it's not just ordinary income or W-2 or anything like that. It's dividends and interest that you're receiving. It's Social Security income, which has different tax rules. It has RMDs from IRAs or 401ks, all of those things. And the important thing to remember, as we found an article in Forbes, talks about your effective tax rate versus your marginal tax rate. And the marginal is the scary one because it's that highest rate that your last dollar is taxed at, whether it's 20, 30, 40%, whatever it might be. But your effective rate is that blended rate that really captures places where there's income that isn't fully taxed, like Social Security or Roth IRA income, or just other places where things are coming to you but not being taxed at the full rate. And sometimes people overestimate how much is actually going to go out of taxes in retirement.
Yeah, that's a really good point. And Dennis, something I wanted to kind of circle back to when you were talking about the tax loss harvesting and tax gain harvesting. I want to be clear too that you can do it intelligently. So we might find ourselves, like we did in 2020, where we had some positions that had dropped down, but they were positions we still wanted to hold or asset classes we still wanted to hold. You could take a loss and buy a very similar position to still get that same exposure. So you're not really out of the market. I think that's the other thing that can be confusing sometimes too, is people think, well, if I take that loss or I take that gain, then now I'm out of the market. I'm not participating in what's happening next. That doesn't have to be the case. So I just wanted to clarify that too.
Right, good point. And Cody, one of the other things that I think is going to be was discovered a little bit last year and probably at the end of this year as well, is just how frequent trading can generate kind of surprise income. It become a hobby a little bit, and people will look at their kind of gross returns, but frequent trading can be the enemy of a tax efficient portfolio too.
Oh yeah. That one article that we brought up earlier from Schwab was going over, you want to have a smaller account and you want to do some active trading in it, that it definitely makes sense to do that in an IRA or a tax deferred account. So you're not having those gains, even if they're longer term, but obviously want to reduce the short-term capital gains as much as possible too.
What is the difference, Cody, in taxes between a short-term gain and a long-term gain?
Yeah, so the long-term gain is a position you held for over a year, and that's taxed right now at the highest rate at 20%. They're talking about potentially moving that up to 25%, but the short-term gain is any position you held for under a year, and that's taxed at your ordinary income level. So normally a lot higher for the individual. So that's why we want to reduce the short-term gains as much as possible.
There's oftentimes vehicles that are offered up as having tax advantages, and that being a great reason to invest. It's one of the selling points for annuities, sometimes cash value insurance policies. But even trust and estate planning, some people will race to remove something for their estate for the tax advantages without fully comprehending what they're giving up in the form of cost or liquidity or other things. So when we talk about taxes as financial planners, it's not in the form of tax advice, which we don't provide, but it is in the form of understanding the tax environment, helping you understand the place where you are in your cycle of income and relative to all the other sources that are coming in to try and make good decisions, because so often taxes are a function of growth. You've made money, so that there's taxes that apply. Then also action. There are things that you might do or not do, like trading or funding particular vehicles. And knowing how those actions play out in the most tax efficient way is really important to know if we get there. Any final thoughts on the subject of taxes, Katie or Cody?
It's always an ever-changing environment. So don't get too used to the numbers that are out there.
Yeah, exactly. And that's what when we talk about flexibility, that's one of the reasons why, because the rules can change and you want to make sure you have an off ramp every once in a while to make a different decision later on as the situation develops.
Yes.
So thanks for joining us this week, and we look forward to updating you further as the year goes on about any potential changes in tax law. But if we can answer any questions in the meantime, feel free to reach out to our team anytime.